Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, December 8th, 2025. So economic data coming out, again, it's very sparse and dated at this point, so not very impactful for the market. But we'll just tell you what we saw last week, starting with the ISM manufacturing PMI number. Now again, 50 is a demarcation line between expansion and contraction. And the expectation was we'd be at 48.6, slightly lower, 48.2. That is for the month of November, so at least it is up-to-date information. Then on Wednesday, we get the ISM Services PMI. Again, same standard, 50 is a break-even point. And that was expected to come in at 52.1, but services came in a little better than expected at 52.6. Probably the biggest number of the week, and definitely the biggest surprise, Thursday, initial jobless claims. So prior to the government shutdown, initial jobless claims clearly were trending up. We had got pretty comfortable around the 220,000 per week, maybe 225. And then it started to move up, 235, 240, and then we didn't get any information. Well, we just got the information for the week ending November 29th, and the expectation was 220,000 initial claims. It came in at 191. That was very stunning. So we've talked a lot about labor market weakness. Still think it's there. Maybe that's just an aberration, but that is a very good data point. So lastly, Friday last week, a ton of economic data. However, everything except for one was September numbers. So again, not quite up to date, and there were no real surprises. So we had PCE, core PCE headline numbers, very much in line. Personal income up slightly September. The expectation was it would be up 0.3% month over month, a little bit better, 0.4%. Consumer spending, personal spending, completely in line, positive 0.3. So the only data point up to date that was released on Friday was the Michigan consumer sentiment. We talked quite a bit about the fact that this has been a very ugly chart, and I think it was just a year ago we were at 75, and it's been almost straight down since. So the expectation for the December reading was 52.0, and again, we're at 75 12 months ago, but it did come in with a little bit of upside at 53.3. So a couple of other things. Atlanta Federal Reserve, we always cite them, and their expectation of third quarter GDP has not been announced yet, but they've been walking back, or I should say, moving their estimate down last couple of readings. So they were as high as 4.1% for third quarter GDP growth. Last week they revised down again a little bit to 3.5. So even if it's 3.5, 3.8, something with a 3 in front of it, that would be very, very solid after a 3.8 increase in the second quarter. Inflation expectations, we're thinking about retiring this chart because it just hardly moves. The expectation built in to the 10-year break-even, 10-year Treasury minus tips, is inflation will average 2.26% over the next 10 years, which is a very strong number, and really over the last, call it 4 months, has hardly moved. Fed funds futures market for a Fed rate decrease. Now that is on this week's economic data, but 90% probability that we will get a rate cut on the Wednesday meeting. Again, today's Monday. That number went up slightly. It was 87% the week before. So with that economic data, in terms of returns last week, equities were okay, better than break even. They were up a little bit. Fixed income down here in the U.S. So for the U.S., S&P 500 up 0.35%. That leaves the S&P up 18.22% on a year-to-date basis, which is pretty outstanding when you consider the tariff issues and concerns that we had in March and April, and first quarter GDP number was horrible. So in total, 18.22% is a very respectable return for this year. Last week, in terms of how the breakdown came in for the U.S. equities, Growth did outperform value. Growth up 68 basis points, value up 6 basis points, but on a year-to-date basis, it surprises me a little bit. Year-to-date basis, despite the fact the Mag 7 has outperformed, value has outperformed growth. In the U.S., value up 16.3%, growth up 15.5%. International equities up a little more than the S&P last week. Developed ex-US 0.74, positive 0.74. Emerging markets up 1.4%. So year-to-date, again, both developed markets ex-US and emerging markets significantly outperformed the S&P. S&P again up 15.2%, fantastic. However, developed markets ex-US up nearly 29%, and emerging markets up over 31% year-to-date. Now, last week, fixed income, we mentioned the fact that it's been a fantastic year. Gave some back last week. 2-year Treasury yields up 7 basis points, a 10-year up 7 basis points. As a result, the Bloomberg U.S. Aggregate Bond Index down almost 0.5% last week. So that leaves that particular index up 6.94% year-to-date, which, again, is a fantastic outcome. So economic data this week. We have the JOLTS job opening tomorrow. This has been coming down virtually every time we see it. It's for the month of September, so no one's really going to care. But for those of you that are taking notes at home, you may recall back in 2022 with a super tight labor market, we had reported this number, JOLTS job opening, at over 12 million open jobs. It's expected to come in for the month of September at 7.2 million. So things have changed dramatically. Now, biggest event for this week, obviously, Fed rate decision on Wednesday. We already mentioned the fact that the probability in the futures market is pricing in 90% chance that we will get a 25 basis point decrease on Wednesday. I can't believe we won't get that. So that'll happen, but that is rarely what moves the market on a rate decision. Everyone usually knows which direction it's going to go and pretty much has the bet right. The real question is what Jerome Powell might have to say afterwards during the press conference. So I have no idea. We'll see. Again, we have very limited economic information thanks to the government shutdown. So maybe there's some things we're not seeing, and we'll find out on Wednesday. Thursday, jobless claims, again, coming off an amazing print of last week, 191,000. The expectation is for the week ending December 6th, something closer to normal, 221,000. So that is a wrap-up for our economic weekly discussion. So we thank you very much for attending, and we'll look forward to seeing you next week. Thank you.